Good evening. Good evening. A big warm welcome. Sorry, it's been an insanely amazing trading day for me. I'll take you through some of the markets a bit later if you want. My name is Adam Harris. I'm one of the traders and market analysts with Trade with Precision. First thing I'm going to do, I've got green lights on my side. I just want to make sure that you can hear me. Sound is good. Should be good. Everything should be fine. And if you can just let me know just by typing into the questions box, just give me some confirmation of that. Interesting. So, ladies and gents, welcome obviously to tonight's topic, and it is obviously chess, not checkers, is the title. And again, my name is Adam from Trade with Precision. So there's a risk disclaimer. I need to give you a moment to absorb, and while we do that, or while you do that, I'm going to tell you a little bit about myself. So I am based in the city of London. I trade my own capital. I trade for a regulated account for clients. It's not a solicitation, by the way. I don't need any new clients. I'm just quite happy with that. I'm a trend-based trader. I'm a momentum-based trader. Okay, so I focus on markets that are moving, which means that I don't try to find a trade if there isn't one there. And that's a really big concept I would like to get across this evening, is how to know if there are opportunities or not, because the markets go through times when there aren't opportunities, and it's good if we can know what that is. I trade multiple timeframes. If I'm doing day trading, I'm trading the 15-minute time frame up to the 1 hour. If I'm trading higher time frames, it's usually the 4 hour or the daily. Lately, I've been doing a lot more intraday trading. It's been very good. And I've traded all markets. So I look at cryptos, I look at indices, indices, currencies, commodities as well. So on the agenda, let's just go back. Sorry, that was very quick. We're going to be talking about the price movements or crypto as well as a whole. I beg your pardon. I want to talk about the key levels, major price levels. For example, with Bitcoin, for example, we've got 30,000, 40,000. These are major levels we need to be aware of. And then we're going to do a market analysis. So when we come away from it, you'll have a very clear sense of what is going on. Okay, what's going on in the crypto markets, what we should be looking for, whether we should be engaging, whether we shouldn't, how to manage a bit of risk. I would love for this to be as interactive as possible. So please feel free to ask me questions as we go through, and I will do my best to answer them to your satisfaction. I noticed no one yet has said hello, and no one has said the sound is good. So I'm a little bit worried that some of you are trapped under rocks and you're trying to get hold of me and scream for help, but you can't because you're trapped under a rock. I'm just trying to make sure you're all good. Okay, so let's go across to the platform. Let's go across that. We'll come back to this slide at the end. And what I'm going to do here, just set off a couple of these. This was that. I'll need the S&P 500, dollar yen, dollar Swissy. We'll get rid of a couple of these. I might add in, I think I might want, let's do the Dow. Let's bring in the tech. Let's bring in tech. And let's bring in some cryptos. Okay, so just shrink these up a little bit. I'm going to do all of them. Okay, so we'll just add all. There we go. Thanks for the question, Marta. That's a great question. I will make sure that I answer that. And actually, I'll do it relatively soon. But I think it's also important to do. I'll give you a definitive answer on that, is what I'm saying. But let me go through how I get to that answer as well. So let's just kind of tap on this. Let's go on this one as well. I'm not sure how many of you are kind of how comfortable. Oh, there we go. We've got Chloe coming in as well. How many of you feel you're comfortable with regards to the platform? I find it relatively intuitive. I quite like it. I'm just showing you how I've set up my layout. So I don't use volume. The reason being, interestingly enough, using volume analysis at the bottom is at its most powerful when you're trading stocks. Volume spread analysis, I mean, it's a nice little thing, but generally if you get a big candle in any market, it's generally attached with volume. So if we're focusing on big candles, we'll tend to get that. Okay, and let's have a look at this. Okay, good, that set me up all of those. All right, so we can kick off without further ado. I don't think I need this, so I'm just gonna push that away so we get a nice bit of screen real estate. Let's have a look at this. So if I jump from, say, Bitcoin to if I jump from, say, Bitcoin to the S&P there, and then I go, of course, here, just switch it up to the daily, and then just stretch it out a bit, you'll see there's some similarities. Okay, so if you just kind of jump between the two, they are highly correlated. They're highly correlated. There is a reason for it. Okay, so First of all, there's so much I want to talk about. There's so much I want to talk about this, but I think first of all, what I need to do, which is kind of important, is just quickly, very quickly, just distinguish the difference between trading versus investing. So the reason this is important that I cover this is because a lot of traders, newer traders in the early starts of their kind of career, and I get that tonight there's a mixed bag. We've got experienced traders in here this evening with respect, and we've got some newer people who've possibly kind of snuck in because they want to learn a little bit more about this, and you're very welcome, of course. But I want to distinguish the difference between these two, because if we don't understand the difference between this, it changes our selection process on where we get into the market, which markets we get into. It changes where we get in, where we get out, how we manage our risk. They're completely different processes. So I want to just quickly cover that, and then I can get back onto the charts and we can go through this. But again, you might have some questions to do that. So let's just imagine that we are looking at, say, Bitcoin or a chart, and it's on a daily chart. It's going up, then it goes down a bit, then it goes up a little bit, then it goes down a bit, and then maybe it starts to go up a bit and it sort of carries on up. So we're looking at a daily chart here. So as an investor, we are looking to put, it's usually a passive, more casual exercise. We're looking to put money away. We don't want to put it in a low interest bearing bank account. We want to put it somewhere where it's going to grow. So we're going to put it into property, we're going to put it into cryptos, we're going to put it into stocks. We're going to put it into one of those kind of markets where we expect it to grow. And as long as we don't need that money, we tend to leave it there. So I'm generalizing, but it's generally true. We tend to leave it there. So it's more passive. It's more kind of like not really time. There's no real specific end date to it. Okay. An example might be someone sells their house and they go traveling for a year. They put the money in the market for a year. When they come back, they take it back out to buy their next house. I mean, that's an example, but that doesn't happen very often. So we're talking about investing now. Okay, so investing is generally a more passive activity. Once we have that money burning a hole in our pockets, we want to just put it into the market as quickly as possible. And because we know that it's just going to be sitting there, we're not actually that picky about the entry. So some people are, but I'm generalizing here. So we just generally throw it into the market. We're not too fussed about where our entry is. The problem is that we also then have to ride out the good times when it goes up, the bad times when it goes down, the good times when it goes up. And ideally, what we're hoping is that over a long enough period of time, it's going to go up. So the first difference is that it's a more passive activity than trading, because we've got the money, we're putting it aside. It's usually spare cash that we don't need. The second difference is that we're not always that specific about the entry price that we get in, because we're thinking long term. The third difference is that we need it to go up. There's a fixed direction. So although we have the ability to sell and buy in the markets, this approach, investing, limits us by and large to markets where we can only go up. So we need the value to go up, we need value, and therefore we exclude something like currencies. Currencies are not a real practical option for investing, because they go up and down all over the place. So this is important, because it means that if you're thinking like an investor, you would stay away from currencies, as an example. Then that leads me to my next point. My next point is that because as long as we don't need the money, we tend to leave it in the market. And so often what happens is we don't have a fixed exit plan. There's not necessarily a fixed exit plan. They might not even have an exit plan. We're just like, listen, I'll just leave it in there. When I need it, I'll get it. So no fixed exit plan. So let's talk about trading. There's a difference with trading. I'm actually going to change the color here because it makes more sense. There we go. So we're going to talk about trading now. So trading, ladies and gentlemen, is when you must earn a salary every month, either a secondary income or a primary source of income from engaging in the financial markets. Okay, so that's the first thing. You're under pressure. If you don't close out, you can only take money out of your account if you have banked profits. So you can't take money out until you bank profits. That's important, because that means you have to close positions continually. They have to be closed before you can benefit from it. That's distinctly different from investing. The next thing is we are very concerned with our entry. We're very concerned with our entry. If I'm looking, so my dog is chasing a fox, apparently. Okay, hey. Shush. So if I'm looking for a nice little bullish candle, I'll put my entry above the high there. My entry is very specific to a pip or to a point. It's precise. My stop loss has a precise point in that it's planned on that. Okay. My risk is usually going to be, say, 1% or less, not more, 1% or less per position. And I'm going to take some profits as we go. So if it goes in my favor, I'll take some profit, get stopped out. If I get another setup, I'm going to be looking to do that. So because we are looking to take money out every month, I am only concerned, and this is crucial, I'm only concerned with what is going on in the markets today and this week. I don't care about 2 months from now. I do not care what the market is doing 3 months from now. If cryptos are tanking 3 months from now as a trader, I'm selling. I'm making money anyway. If they're climbing, I'm making money anyway. So it's important, because cryptos is specifically is an area where people, because it's new and people involved, they're jumping between trading and investing. And tonight we are talking about both, but we're going to be focusing on trading. So this is hugely important. And when the market's going down, I become a seller. It's very tricky in the periods where it's going sideways. We tend to avoid it. So there my entry is precise, stop loss is precise. Take some profit, get out. It's very precise. And I'm going to be doing this all the way along. So I don't really care whether it's going up or down. I don't give a darn or whatever. I don't give a damn what it's doing 6 months from now or a year from now, because I'll be benefiting either way. That is crucial that we understand the difference between that. And finally, it must have an exit. It has a fixed exit. So usually we are looking for a 3-to-1 for our average trade, 3-to-1. Meaning that if I risk 1%, I'm trying to bank 3% on that move. That's my average. Some days I'll get 2-to-1 or 1-to-1. I won't get the full target. Some days I'll get 5-to-1 or 6-to-1. But that's my go-to kind of approach. This is crucial. So if you're already finding yourself, oh, okay, which one am I? We need to clarify that, because it changes your risk approach. It changes which way you're going. Because if you are investing in crypto, but you get in on a trade and you decide to buy. So here you decide to buy, then the market starts going down, you take your stop loss away because you go, you know what, I think in the long run it's going to go up, and then it just keeps going down. So now you're on the wrong side because you're not, you weren't behaving like a trader. You went in like a trader, but you've switched to investing. Okay, it's really important to clarify that. Okay, good. Now that we've kind of covered that, in answer to your question, Marta, which was a great question, I want to just quickly clarify that any market, any time frame can only exist in one of 3 states. Okay, there's either no trend, which is when we're mixing up our highs and lows, which is ranging or basing. This generally will take our money. Whether we buy or sell on it, there's about a 65% probability we will lose money if we engage in a market that is going sideways. So that leaves the only other 2 states a market can be in, which is trending to the upside when it's moving up, or trending to the downside when it's moving down. Statistically, there's only 3 ways to trade the markets. In a range, sell at the top, buy at the bottom. So you buy here, you hope it goes up, sell at the top, go down. It's okay. Like, if that would be my second preferred way to make money. The third way, which is the worst, is reversion to the mean. This is when people think they're being very clever. They're trying to sell in an uptrend or buy in a downtrend, which statistically is even worse than trading this. So that's my third favorite way. It's very stressful. The reward is inverse. It's you're going against the grain. It's crazy. So we are looking at trading with the trend, which means we are looking to capture 50 to 80% of the average move if we can, or 3-to-1 if we can on average. And so we're looking to trade with the trend. Then it really becomes, if we know which way it's going and it's trending, then it just becomes about where do we get in, where do we put our stop loss, and where do we take profit. And that's the overarching concept. So trading is not about complexity. And this is another thing. A lot of people, my brother is very much into Tesla. He worships Tesla, but he's still at 3 o'clock in the morning is watching videos on YouTube from rando kind of podcast people about why Tesla is bulletproof and it's never going to fail. And this kind of stuff happens with cryptos as well. So I'm going to go with the technicals tonight. We're going to specialize. This is what we do. And we're going to look at the technicals, and the technicals, whether we like what they're telling us or whether we don't, this is what's going to happen. These are actual orders that are in the market. And so we're going to take it from there. Let's go back to the platform. Okay, so the next thing that I wanted to explain to you is, why is there this high correlation between cryptos and the index markets? It's actually, you need to know this because it helps eliminate conspiracy theories and all kinds of voodoo out there that isn't real. The fact of the matter is that cryptos were born out of a desire. There's a building mistrust in banking, not, it's your money in the bank, but they won't let you touch it kind of thing, and also government kind of oversight. So we're kind of getting to a point where we're feeling a little bit, and this is normal, everybody's feeling it, but some people really hate it, some people are annoyed by it, and we've got a degree of that. So cryptos were born, and not just that, but we've got this massive global trade. Actually, I've just had an idea. If you aren't offended by this, I'm going to put my camera on so you can actually see my face, so you can put a face to the kind of, well, so you can do that. So I'll just activate that and I'll move it out the way, and then you've got a real person. So you can see me here. Okay, so cryptos were born out of that desire for an alternative currency, which we possess that nobody else can control. Okay. Secondly, we're becoming one planet. We're doing so much online business and it's all international that it kind of makes sense to lean towards a particular currency, like just towards an online digital currency. It makes sense. Now, first of all, paper money only has value because the banks say it does. And originally paper money was tied to gold. And again, gold only has value because we attributed value. because it's shiny. And there was a time 500 years ago you didn't use gold in technology per se. It was literally mostly used for trade. So gold has value because we give it value, and so therefore it's a commodity. If you have a piece of gold in your pocket and you lose it, that's it. It's not backed up anywhere. You lose it. If you go and you hold on to it for 5 years or at any time, or you lose it and you find it again, you can only get what it's worth at the time you got to sell it for at the market, and vice versa when you buy it. So cryptos are the same. Cryptos are basically where as a society we've progressed from gold to paper to digital as well. So we're a hybrid of both. And so it makes sense for us to opt for something that allows us, especially even something international, that allows for us to use as a currency, and it has value. In fact, there might even be some ways in which it's going to be difficult to counterfeit cryptos. So it's already some ways cryptos are actually, they have an advantage. But if you're a government, not a government, if you're a bank, they make a lot of money. And so they look at this growing market and they want a slice of it. And this is very simple. So from in the city, and I know this because I checked to some of the big institutions, they want access to that market. If it was NFTs, they want access to that market, especially when it's stable and it's growing. NFTs are still quite new. But the fact is that cryptos are a digital commodity. If you've got it on your sticker on your phone and you lose it, your digital wallet, it's worthless. Same as that losing that piece of gold, okay? And again, it's what it's worth for at the time it is in the market. And you can mine it. So you can go and mine gold in the hills, and you can go and mine Bitcoin. That's how you just need to perceive it, as a digital commodity. This is for people who find it kind of quite difficult to understand. The next step is the big institutions, the hedge funds, the investment funds, mutual funds, the banks, they want access to any market that is legal and huge. Okay, so they definitely want access into the crypto market. Bitcoin's popular, Ethereum's popular. They want a piece of it, and it's now established. It's not just 5 years old, it's 10, 15 years old. They know that it's real, it's being used, it's gaining ground. They want a piece of it. So the reason I bring this up is I've got to finish off the regulation part as well. So the thing is that the whole point of cryptos initially was that it's not government controlled, it's not bank controlled. So governments around the world can ban crypto or try to say that it's not being used anymore. It will make no difference. It'll slow it down a little, but actually the fact of the matter is the people who want to use it, half the people who want to use it because they don't care that it's not regulated by that sense. They don't care. They want an alternative. And the other half would prefer that it was regulated. So the banks are very clever now. So what they want to do is, yes, they're giving some credit. So you've got like Starbucks in some countries that are accepting payments from Bitcoin. South America's using it as a currency, Ethereum as well. So this is where it gets interesting, is that the banks are trying to compete. So they're introducing what they call central bank digital currencies, CDBCs, and they want to now see if they can capture that market. So, I mean, it's ridiculous, but the difference is, I suppose, it's bank-backed, and they'll probably use the same kind of technology, which is very secure. We need to remember how much security has improved thanks to cryptos, how much they've changed that. So my point is, digital currencies are absolutely going to be growing in the future. The question for me is really going to be, is Bitcoin the grandfather of them all versus Ethereum? It could be a VHS Betamax scenario. So I'm obviously not young, but so there's we could find that maybe in 10 years time, Bitcoin has kind of lost its interest or its shine, and Ethereum is maybe the big daddy, and then maybe a few others have kind of taken over. We are in the infancy stages of digital currencies. But the idea is still there. They're not going anywhere. And chances are that for now, we'll lean on to one or two of them a lot more. So I've kind of got the top 6, but Bitcoin, Ethereum. And I love Ethereum because I feel that it has more, it's almost like a version 2.0. It's a Bitcoin 2.0. It's got a little bit more room to run. So you just have to take that into context as to where we are in the history of it all. And so the institutions have started, because what happened was there's been a lot of money in the stock market. This is crucial. This is why there's a correlation between cryptos and equities. They've run out of things to sell to their clients. They're like, here's Amazon and here's Apple and here's Netflix, and the clients are going, I've got enough. Like, I'm overexposed in Apple, I'm overexposed here. These are all the billionaires and the millionaires. I'm overexposed. So the guys are like, well, what if we throw in a bit of cryptos into that as well? And they're hearing the buzzword and the vibe. So big institutions have started getting into cryptos in the last few years. But it's important to understand that they have way more money than the average individual citizen. So a big chunk of cryptos right now is owned by institutions, the same people who own equities. And so when clients are panicking or offloading, they're offloading, you're seeing a correlation between equities and cryptos, and that's it. Big institutions are just got a big chunk of them, they have more money, they can buy them. And that's why we are where we are. What's important is that when the markets panic, we tend to see a bit of a move to the US dollar, a bit of a move to, so we see a bit of safe haven behavior running to, say, dollar yen, maybe a bit to gold. The reason is that sometimes though gold at the moment is not really performing that well. And the reason is partially because actually sometimes if their portfolio is really full, the big institutions will sell stuff off their books. And they'll sell the stuff that's not really moving much, which is like gold. So they'll get rid of gold, which can cause gold to go down. So if you're not seeing a correlation between the US dollar and dollar yen and gold, it isn't there. It's really important that we have these beliefs that there are these things that are fixed, correlated, and the market operates in a simple fashion. But unless we physically see it with our own eyes, it's not happening. Markets can become correlated, they can become inversely correlated, and they can just uncouple. So it's really important to understand that what I think is important is there's going to be a point in our time where we'll know that cryptos have arrived for certain when we see equities tank a bit and we see money flowing to cryptos. Cryptos start to become potentially a safe haven option. And the reason why it's quite clever is because you offload it internationally. If you're in the US and you're a US institution, if you offload it to cryptos, Bitcoin, for example, is a global currency. You're offloading it effectively to the rest of the world a lot faster. So there are reasons behind it. Okay, so let's get on to the technical analysis, but I wanted you to understand why there was such a strong correlation between the two, which is now going to lead me to doing some quick market analysis on the indices so that we can work out how the indices, when the indices turn, we'll know, and we see it in cryptos, we'll know cryptos are going to make a comeback. And I'm going to give you a specific list of things to look for so that you know, okay, if I see that, I see that, I see that, we should now be on the way back up. So the first thing I want to do here, we'll go to the S&P 500, which is obviously 500 large cap companies, and they're all around the world, Nike, Starbucks, you know, McDonald's, everything. And so because they're all around the world, they're a very good indicator of the global economy. Okay, so the US economy, excluding China, is the biggest in the world. It's bigger than the next 8 countries combined. And the US dollar is used in 90% of the transactions on the planet. So we need to know what is the state of the US economy. And right now, they're under a bit of duress, but they've also had way more growth. If we go look at them from a monthly perspective, you can see here, this is the kind of growth that they've experienced going all the way back to 2000 and 2007, 2009. Some phenomenal kind of growth, very steady, very set kind of angle. So what I would like you to just observe here is, I'll go back to my original color, is this angle, very steady, very slow and steady, and then something shifts. There's a bit of an acceleration here, and then there's much more of an acceleration here. So it's almost gone parabolic. The thing about parabolic moves is often there's a bit of a deeper correction when it happens. So it's kind of back in line with that original angle. So if I did that, if I had to go and draw a trend line into this, and this will relay through to cryptos. You don't think so, but it will. Let me just go and move this down a little bit, and we'll do vertical. No, man, trend line. So let's just mark that out and get some. I'm just running a line roughly through the middle of it. Okay. So roughly through the middle of it, that's kind of true value. So remember this is really cool. The market doesn't know when it's like just an organic animal, like a flock of birds. It doesn't know when it's undervalued until it turns around and starts to come back. It's like, oh, okay, we're actually undervalued. I want to go back. So the market doesn't know that. And it also doesn't know when it's overvalued. Some people can look from the outside, like we are tonight, and we can get a sense of that. But the market will go down and go, actually, you know what, we're overvalued. And it's trying to find that perfect value, but it never can. It overshoots it and then goes, oh, actually, perfect value was back here, and so on and so forth. So basically, the market is orbiting true value. In other words, the right amount. And we're looking on a monthly time frame, we also get that same kind of effect. So my point is here, we've had a bit of a move to the upside. We've had, from this point here, we've had 2 years of insane growth. In the past, you could see move up, pull back, move up, pull back, move up, pull back. Here, we just went straight up. And now we are consequently correcting. It doesn't matter what causes it. Going throughout history, there's always going to be something. But inflation or rate hikes will be a major trigger. Rate hikes are a consistent trigger, obviously, of a correction. So part of the reason the markets have boomed so much is because it's really simple. It's interest rates. Low interest rates, QE, quantitative easing, cash, you know, like subsidizing by the government, all these different things where big institutions can borrow money at almost 0% interest. Sometimes they don't even have to pay it back. They can throw it into the stock market. They'll get 18 to 50% returns, massive returns over a period, take some big paychecks. Clients are happy. It's a very low risk scenario for them, but it depends on kind of free money from the government and low interest rates. That's really what they do. So as soon as the country starts, the banks, central banks start talking about rate hikes, then there's this fear. It's like, oh, okay, because then all of a sudden the profit margins aren't as thick, and so there's a bit of concern. So usually what they will do is start to extricate themselves. And when they do that, there's a bit of a shift. So there was a whole period here where there were concerns about inflation, but the government itself, the central bank, hadn't really started to talk about it. No, everyone's kind of like murmuring, will we do it, when we do it? And then of course now it starts to kick in and the market is starting to shed some of that much needed fat, because that market growth is absolutely ridiculous. And more so in America, when you go and look at some of the other indices, they haven't experienced the same growth in the UK, not even in Germany, haven't experienced the same kind of growth. And so the correction is not as harsh, but we are tied to the US economy. We are impacted by it. In 1929, when they had the stock crash, it was a global depression. It was a US, New York Stock Exchange crash, and it impacted the entire planet. So right now, large parts of the move are due to the market having been bloated, and it's letting off some steam, much needed steam. It's coming back down. If this lets off the steam relatively quickly, we could be back up near the top or back on our way up by December. So within the decade long, and this has been going for hundreds of years, within a very short period of time, we should recover. And I'm going to talk about what I'd like to see, but I want to give you a sense of where price could feasibly come back to, and then it's back in that true value range, and then it'll recover. So imagine if you're President Biden, and of course all the Americans are saying he's a terrible president, blah blah blah. Chances are that actually, if this unfolds in this way, and we get the war, obviously Russia and Ukraine, this is all tied to cryptos. So if you're thinking this isn't relevant, it really is. The war in Ukraine has created, global hunger because of the supply. Ukraine is like this jewel in the crown. It provides like 40% of the sunflower oil in the world, and wheat and bread and all these things. And then of course Russia's the energy, supplying huge amounts of energy. So they have created big chunks of pressure and supply chain issues, which has created demand issues, which has created inflation. And COVID has created supply chain issues, which has added to the inflation thing. So if we take those things away, if COVID wasn't here and the war came to an end, then once that's fixed, we would really then be able to see, okay, how bad are things really? Like really, there's some inflation maybe, but because instead of money going to the 1%ers, like the billionaires, it's actually now started to drip down, and people have some good jobs, income's good, people are spending, they're fixing up their houses, they're working from home a bit more. And so we've seen inflation because actually when the bottom 90% are spending, that triggers a lot of kind of inflation, because a billionaire buys one yacht. But when you have a whole lot of people, several million people fixing up their homes, it creates more of a knock-on effect. So, but when those things are taken away, if the war comes to an end, and I don't know when the outcome of that is, but I know for sure that as it's being fought now, Russia will never win. So we don't know what the outcome of that is, and it would be great for an outcome where possibly there's a new power in Russia that decides they want to be a democracy. The market would recover so quickly off the back of that, because all of a sudden the supply chain issues from that side and energy stuff would come to an end and would turn around. So that could be something feasibly that happens in the next 2 to 3 candles, next 3 to 4 months. Could happen. So if it does, I would expect to see a massive, massive boost across the board. But let's see how that goes. So this is an area where I feasibly expect it to do. Support and resistance levels are also major. These are price levels where the market has come to before. It's broken out, pushed up higher. And so what I want to do is discuss kind of the areas. You can see here where we've sometimes come through to the 50, headed away, come back, headed away. So now, in terms of what I want to see on cryptos, before we go across them, is when we pull back, you'll often see, so for example here, you'll see we head away, we pull back red candles, we get a nice little green candle, we break the high of that green candle, and we take off on our next move. Here we pull back, we get a green candle, but we didn't break the high of it. We did a deeper pullback, and then we got a green candle. So if you look over here, we produced that, we came back to the moving averages, the blue and black, the 10 and 20 moving averages. We produced a bullish candle, we failed to break the high, and then we closed just below the low of that, and we've moved lower. So it's a similar scenario on a bigger scale. So in answer to somebody's unasked question here, what are one of the things that I need to see to indicate that we are potentially at a bottom? I would need to see a green, solid green candle, either at these levels or potentially in this area. I'd like to see a nice green level. I would need to see that green candle everywhere. I want to see it on the S&P. I want to see a green candle on the Dow, on the tech charts, and on cryptos. if I see a green candle across all these 6 charts, or actually 7 charts, that is a phenomenally good sign. At that point, the next thing that has to happen is the next monthly candle has to break the high to give me that confirmation. That just tells me the market is going to tend to go higher. In most of these situations, it has followed through and gone up. It hasn't. It could, if we're going to be in some kind of weird dire situation for the next few years that is very unique. That's like a black swan. If we are, which we might not, we do need to let off steam. And once we get there and housing prices drop and everybody calms down with the spending, then we can probably recover slowly and cautiously. And I think until we truly calm down, I don't think it's going to really be able to resume and go back up. But there's a lot of money out there that wants to do that. So the point is, a solid green monthly candle. Now, I don't think that in the remaining 11 days of this month, give or take, we're going to turn around and produce a strong bullish green candle. But if we did, that would be great. But I need to see it across all 7 of these charts at the same time. I think it's more likely we could potentially head lower and then do it. So we could see, let's imagine a scenario. We could see this month close lower, another month close lower, and then a green candle, and then a break higher. So I'm trying to imagine 2 or 3 different scenarios and how they would play out and what I need to look for. But also what that does do is that tells me, and all of you, now is not the time to buy unless you're thinking long term. So in other words, I need to understand the market can continue to go low. So let's go across to a crypto. Let's have a look at a crypto by comparison. Let's go up to the monthly, and let's have a look at kind of where we are. What are these major levels? So you can see it's trying to stay above, let's call them round numbers. It's trying to stay above 30,000. It's really definitely trying to do that. So how you often know you're in a range, how you're going, because remember you've got 3 states, a trend or range. So a range usually happens. So you're trending. This is good. You're trending like this. You're trending, and then you actually get an equal high, pretty much, and close to an equal low. Okay, cool. And then you sort of broke, and then it starts acting up. And this is kind of what's happening here. We went up to this high. We came down to here. We actually, ladies and gentlemen, we actually didn't break to a new high. It's a failure at this point as well. And that's really the line there. That's the line there, 60,000. Next up, we came down, we tried, because actually this is a breakout pattern. Check this out. A bullish breakout pattern, and I want you to remember this, please. A bullish breakout pattern can look like this. It produces a series of higher lows going into that. And we've broken that. That's what I thought was going to happen. I thought we'd come here, go up here, produce a higher low, kind of do this potentially, and then break out. But we didn't. We actually came back down here. But here we've managed to produce, again, guys, we're at the bottom of that range. So currently we have gone from a trend to a range. We are currently in a range. Now a range doesn't really just do it twice and then go. Often a range is long term. It is a very fair assessment to say that we could see one more move up, one more move down, and then we're gonna have to see if we break out or go back up to the top and break out. That I think is very fair and reasonable. And so what I want to do then is get a sense of, okay, well, how long are we talking here? So if I go ahead and I want to get a sense, so let's say we started this range here at, this is in, just getting a sense, I want to put a time to it. So we're talking, that was January 2021. And we do a similar one to where we are kind of July, June 2022. So that's a year and a half. Another 18 months is a possibility, could be the case. So let's have a look at a couple of scenarios here. What do I need to see? If this can stay where it is, now if equities keep falling, so this, you got to look at both at the same time because they're very correlated. If equities keep falling, and I look at this as well, and the monthly gives you some real perspective. You might not think the monthly is important. The monthly will give you big picture perspective as to what's going on. So here we've got a bit of a level. Here it is. I wish I could save these ones as default stuff. I can change the template, but I can't seem to do this as that. So just going to do that and thicken it up, and that's my level. Look at that. That's beautiful. Coming back to the 50. To me, I think there's a really high probability this is going to come down. 3,000 is a nice round level. Could do that. But I think it's going to be drawn to these old highs to test this level that was resistance as support. I think that's a fair possibility. Does anyone who's listening in tonight use Fibonacci? Fibonacci retracements. Does anyone use those? Let me know. So this is kind of what I'm looking for. So I think it's fair. I'm not sure if we'll keep dropping in this single candle. I think it's likely that if we do come down here, we'll have a second candle, and that candle could close like a nice green candle. So I think the earliest we can reasonably expect green, let's call it a green shoot, like a little seed of potential bullishness, of a turnaround like this, would be next month. That's the earliest. I don't think we're going to get it this month. But if we do, guys, remember this. If we close up at the highs, a solid green candle looks like this, or looks like this, and it closes near the highs, like it's almost right at the top, that is a fantastic bullish sign. So if we get it here, it's 1 month. If we don't get it here, if we go down and then we get it after that, so we're talking. So that would be, I was going to say, are we on June already? No, we're not. That's July, August. That could happen. And then we got to start the slow climb up. And a small green candle counts just as much. So to me, it's saying right now, be prepared for the market to go further. Keep an eye on the monthly candle. That will be the clue. So that means that I've just got to be patient. If I am an investor and I'm happy to buy here and be okay, and I'm thinking 5 years and I'm okay for it to drop further, which is why we ended up going to the Bitcoin chart. If I'm okay with that, then I'm thinking long term. So remember, there's a level back down here. If we break through this, there is, to be fair, there could very well be okay, there could then, to be fair, let's put that level in there. That's that one. Top of our range is actually there. Okay, and there's a midpoint. And that's another reason why it's a range, because a range usually has a central axis. Which is the midpoint. It does that. So if these manage to stay here and we get a nice green candle here like this, to me, that is a high degree of certainty that if the next candle breaks the high, we are going to work away. The smart approach is to accept that at the very least we should probably just get up to here, but not to assume that it's going to keep going unless, I'll tell you what a clue is that tells you it's out of the range. We are in a range. Like, that's it. We're done. We're in a range. There's no way around it. But how do we know when we're out the range? When we see a candle break out and close substantially outside the range. Usually, most of the time, like 90% of the time, that is a confirmation the breakout has happened. So we need the candle to close up here, maybe with a little bit of a wick like that. And then we're probably gonna get out. We'll see the next candle will come down here. So we'll probably have something like this. That's probably what happens. So the smartest thing to do for me potentially would be to do some buying here if I get a green candle in this area, and to make money on the move up. And then if I get a bearish rejection candle like this, take some profit and exit the position, because it's then likely to come back down towards the lows again. So if we see the same behavior here and we are in a range, I'm telling you, there is a very high probability that we're going to see that. I would expect this to go. So your question was, do I think we're on a bear market for crypto? The best definition for me right now is that we are in a range, but that'll be confirmed if price stays above here and we get a nice green candle. If price breaks through here, the next level down is going to be down towards the 50. It'll tap the 50 and potentially down here. I think that's really far down. I think we're likely looking at probably this area here, but I think we're in a range, and therefore I think it's going to try desperately to stay in here. It might drip a bit and then come back up, and drop a bit and come back up, but I think it wants to stay in this area. We'll see. So I'm going to say that we're in a range. Once I see that green candle, which could, as I said, the earliest, which to me is very quick, but it means the markets are recovering. And again, if the war in Russia, with Russia and Ukraine ends, and we get that, that actually makes sense. If we see that, then I would expect it to go up to the top. But because I know we're in a range now, and ranges usually don't exist very quickly, they usually are 3 or 4 or 5 bounces. I think it's, for me, I'm going to be, I need to see it really break out of that range before I commit to it. Okay, it's out of the range. I expect this to do, I expect it to go back up, probably come back down, and probably come back up at a minimum, which means that that puts us at end of next year. End of next year, we'll still be up there. So the interesting thing is, if that mirrors equities, we could well be in for an interesting year or two, and it will be tied to the war in Ukraine. So we're just going to have to kind of see what happens with that. Not to mention, of course, that a lot of the Russians and Ukrainians are using cryptos, you know, the Russians are using cryptos for their nefarious reasons, but the Ukrainians are using it because of refugees and trying to help people and donating money and stuff. So they've got a whole lot of stuff going on. So it's tied, it's linked to that as well. Next question. So that's really what it is. Good, fib levels. So the reason I asked that was because if I go back to any of these, the Dow, the S&P, the NASDAQ, and then I measure them. So I use a Fibonacci measurement, not that one. There we go. So let's do a Fibonacci retracement. And I do it from the low of here all the way up to the high, for example. We're only just coming back to the 382. Now, yes, it depends. You might want to measure it from here as well. Here we're coming back down towards the 618. But if you do it from the low of COVID, we're really only just coming back to the 382. It's a big move up, and it's not really a very crazy move to the downside in isolation. If we were looking at this on a 1 hour chart, we wouldn't really be concerned. And in fact, it's strong all the way down to here. The 618 is down at this level. So then, and 50 fib is up at that level. So this is a really good kind of layout. And so my point is, I would also be happy if I see this stuff happening on a fib level. Now, fib levels are not as reliable to me, at least to me, in ranges. They work really well on trends. So that's why I'm kind of going to measure them here. For those of you who may not be familiar with fib levels, they're simply just measurement tool. It's all a story behind Leonardo Fibonacci, who's not Leonardo da Vinci, but famous mathematician. And he just observed that we have these patterns in nature, and they tend to be to do with proportions. So there's a natural ebb and flow that we have. And often we get these interesting proportions that the market comes back to. And it's cause and effect, because some people use it and other people watch other people using it. It just tends to become real. So I just wanted to highlight that the pullback might seem very dire when we look at it in the news and all the drama, which is ridiculous because it doesn't help the situation. And remember that often markets are at their most bullish at the highs and at their most bearish at the bottom of the market turns. If you are looking for recommended reading, you know, it's like Peter Lynch's One Up on Wall Street is a phenomenal book where he did. So anyway, I wanted to just highlight that. So again, if I see a green candle form across all of these 7 charts, and the next candle breaks the high, then I think it's safe to assume we do that. So wouldn't it be interesting if we get it next month, and we also get it, so if we go across to Ethereum against the US dollar, so let's go up and measure that on the monthly. And then I want to talk a little bit about kind of what we can do now. So it's also sitting at the bottom here. So really the Bitcoin is, and it's unlikely that Bitcoin is going to, and Ethereum will not behave. They're very highly correlated for now. Not 100%, but highly enough, correlated enough that we need to pay attention to it. In fact, the second things that aren't correlated is also a signal. So after a while you get used to it. But this is really good. So I think this is a major level. I think it wants to stay above 30,000. As I said, if there's a nice little green candle that we start to get, then I really like the look of that. If we break through here, then it implies we're not done yet. All of it's connected. So if crypto starts to tank through that and equities are hitting low, it just means, look, we're not there yet. We'll know we're there when we get that nice green candle, and then it potentially starts to turn up. But I think based off this, it's going to want to stay where this is. So we're going to be doing these webinars every few weeks. And actually, I'm on YouTube as well. If anyone's interested, I'll give you the YouTube thing. But if you look up Adam Harris, London City Trader, you'll find me. But I'm looking at Bitcoin every week. So I'm going to be on. All right, there we go. There's the green candle. All right, now I'm looking. Those are the buyers have returned, and it's kind of lost that momentum. So let me talk you through a little bit more of this. So Ethereum and Bitcoin, we've got those. Let's go down to the lower time frame. So we've got Bitcoin against the euro, which I find very interesting because Bitcoin and Ethereum against the euro could behave differently than against the US dollar. They could, but I would always treat them as a pair. So I'd always look at Bitcoin and Ethereum against the euro slightly separately from Bitcoin and Ethereum against the US dollar. They are going to be correlated, but they might not be tightly correlated. They might actually end up doing their own thing. You could have a scenario where, for whatever reason, the euro itself gets really, really weak, which could find cryptos climbing against the euro, as an example. Maybe because of the war. So I'm a technical analyst, by the way, but we're living in a time now where there are clear fundamental cogs that we know what's going on, which isn't always the case. So if I go back to this, what am I looking to do? So this is what I wanted to kind of share with you. We're going to look at the weekly chart. So when you go down to the weekly chart, the one you really want to pay attention to is usually the 50 moving average. So we are in a downtrend, guys. We've got lower highs, lower lows. We've got a major support resistance level, which is up here. Actually, I want to just bring it in. So we've got a little bit of a one over here, but actually, I also kind of want to let's talk about it. Yeah, that'll do it. Okay, so we've got 4-3, and we've got another one just down here, which will kind of lighten up over here. That's fine. We've got those. So those are really. I just don't like the default colors. Okay, there we go. Take away the grid so we can see these lines. So this is, yeah, so again, you can see what's coming in here is the breaks. Okay, they're trying to put the breaks in. These are buyers stepping in. When you get all these wicks along the bottom, the market is trying to kind of do that. And the other thing I wanted to mention is that when you're a really like calm, steady investor, like Warren Buffett, or just a seasoned investor, when the market starts to get very expensive, you start either diversifying, or you start selling, or you just stop buying. What you're waiting for is a correction. And so I want you to understand that there's a lot of buy orders sitting down there. A lot of people with a lot of money are like, listen, if I can get back into Apple at this price or this price, I'm going to be happy. So they have orders all the way down because they're like, listen, the further down it goes, the more I can get back into a blue chip stock. So I just want you to be aware that when the market drops, why you get these bounces is because when they fall, they hit all these orders. But if it isn't enough to change the tide, it keeps going down. But just be aware that lots of people are buying on the way down. And eventually at some point, there'll be more people buying than selling, and then it'll turn around and it'll start to end up. So the other thing I wanted to draw your attention to is if we kind of look at the history of it, for the most part, the price is above the 50 moving average. It breaks below it here, but it's generally above the 50 moving average. So here we are, we were above the 50 moving average, we've dropped below it. So the reason I'm bringing this up is because the 50 moving average is going to be a second, or another thing, not a second thing, another thing that I want to see. So I want to see the following things. I want to see price produce a change on the weekly chart. I want to see it shift into an uptrend if I can, ideally, if I can. And at that point, I actually want to see price go back up above the 50 moving average. So we're not really there. We can see the 50 kind of starting to bend down. And so we're still probably looking in this kind of a period at the earliest. And I'm looking for price to do that. Again, it could come here, and then it's a downtrend, comes back up, comes back here, can't go, goes any further. But I would say if we subsequently get a move higher and a higher low, so we get an uptrend, that has become a very messy drawing. So let's kind of do this. So say we get something like this. So price tries to go there, kind of can't, but then it manages to break, and then it manages to get there, and then it's above it. So now we're shifting from below to back up above it. I would say that is sufficient evidence, combined with a monthly, by that time we'll have a green candle. That would be that, like, okay, I'm starting to get to a point where I could now start to comfortably look for buys, because there's a point where you're going like, Adam, I'm not confident. So when can I be confident that we're probably now back on track for the new uptrend, back resuming the longer term bull market? And that would be it. So once I see that I see an uptrend, high lows, high highs on the weekly, and it's above the 50, like that's it. 90% of the time we are safe at that point. We're going to start going higher. Okay. And then we'll deal with what's going on, because again, I can give you ideas of what I think is going to happen in the next 2, 3, 4 months. But as it's unfolding, I can go, okay, we had 4 potential outcomes. Okay, it's not those 2, it's going to be these 2. So again, I recommend that we attend these more often. So I wanted to show you that. So what does it mean in terms of trading opportunities? Let's go and focus then on cryptos now. Because we kind of roughly know what they're doing, let's go down to the lower time frames for crypto. So you can see again, we're under that 50 moving average. Again, we were here, we bounced off it. I'm not using it as support or resistance, but I'm just saying, look, there's an interaction with it. Then we dip below it. We couldn't get back over it now. So again, I need to see price go back up over it on the other side of it. And that is not going to be for several weeks time. So it's not that we're saying cryptos won't go up in the future. I'm very confident in the long run cryptos are going to go up. I very am. The question is this level able to hold, or are we going to find that it dips a little bit lower? And then I'll know that it has started to turn when I see those changes. So there are very definite things I can see and go, okay, we're fine. And so I'm going to be looking at this as well. If we're going to get a bounce back up to the upside, this is a very interesting type of pattern that happens here. We had a bit of a bounce, green candle, tried again. This then was another attempt to go higher. Didn't quite get there. So sometimes it has these, it's a tipping point. You don't have enough buyers yet for it to take off. So, but it tries, then fails, and then it tries again, and then eventually there are enough buyers and it goes off. And so the clues, it's beautiful. The price action is amazing. That was an attempt. And that was an attempt. Oh, let's go again. I keep drawing badly. This was the first attempt. It was too early. Wasn't ready yet. Then it didn't go anywhere. Then it did try to push up. The next candle tried to break through and then failed. It came down. But then another buying week came in here. Which is good. So what's happening now is more and more buyers are coming in. You go from red candles all the way down to 1 green candle, then 2 red candles, then another green candle, then 2 green candles, and then it starts to shift. And then we had this one. So we actually had, the third one was a little bit more obvious. We had a rejection here, rejection here, rejection here, and that was a really nice one. And then it took off, and we broke above these highs. And look at that. Then it broke, came back, tested it, and went all the way up. So again, what do I need to see here? Well, I think it's understandable. There's a level there. I think it's feasible we could get something similar to this, price up there, then maybe a break above. That would be a great sign. Then it must reject this potentially and carry on, something along those lines. And again, it'll battle through those. But I think once it's on its way back up here, we're going to see it potentially start to hit all the way up to the top. So I'm looking for a series of green candles that look like that. I'm looking for these kind of things over here. And I am prepared. It could go straight up in one go, but I like to see it potentially try again, and then the second time it definitely goes up. But so it's either one of those two scenarios. And again, green candles become clues, especially with wicks. Wicks are crucial. Little wicks like that, especially when you get two wicks next to each other like that, they are often, in combination with the other colors of the candles, very, very strong signs that the market is going to take off. And these are kind of levels that I want to pay attention to. So I need a high, low, high, high. So right now we have a monthly downtrend, a weekly downtrend, and this level is crucial. So it's struggling. It is struggling to stay here. And again, you might go, well, is it going to hold? And the thing is, I need to keep an eye on equities, because if equities are going to fall, they're going to pull cryptos down with them. I think it's unlikely that if equities fell a lot, that cryptos could stay where they are. I do think it's possible that if cryptos were roughly in the area where they're going to slow down, I think cryptos might be able to hold it there. But if there's a big fall on equities, it's just too much selling pressure. It's going to pull it down. So again, I want to see a nice little candle, and hopefully this is the case. Another thing, let's talk about these two indicators here at the bottom, and I am aware of the time. We've got 6 minutes, but let's go on and have another look at this. So we go down to the daily, and I want to talk about how we use these indicators in the city. And some of you may or may not use them this way. Again, I mean no offense to anyone if you already know this stuff. I don't mean any of that to you, but this is a very nice, reliable way. So I use the MACD and the RSI, both of them as a double confirmation, okay? And I don't choose overbought, oversold, or histogram on the MACD or moving average crossovers. The best way that I've found over the years that's very reliable is to compare the trend. So if you're looking here at price over time, if the chart is price over time, this is the speed over time. So what these two are measuring is the momentum of the market. Is the market here as faster or slower or the same as it was here? And actually it's faster. So it was going nowhere here and then it started moving. And actually what happens is when it's moving, when the market is moving with intention, the indicator will move with it. So I'd like you to observe this. Basically, what I want to know if a trend is healthy is if I see price trending up, higher lows, higher highs, and the indicators are trending up. If they are both trending higher, bang, then that trend is nice and healthy. In other words, there's a momentum to the trend and to the indicators as well. And vice versa. If price is trending down, which it is over here, I want to see the MACD trending down and the RSI trending down, which I do. So the trend to the downside is currently relatively healthy. The problem comes, and for us, we're going to use it to our advantage, is if you have a trend going down and the indicators have started to trend up, they have gone bullish. So trending up is bullish, trending down is bearish, and they've started to change. So that's what I'm going to be looking for. Okay, so what I think is likely to happen here, potentially we could have price go up and come down again and do that. And when it does that, maybe it'll create a lower low, so you'll have a similar low here. And actually what will happen is we'll see that happening. We'll see a higher low. So let me show you where that's happened literally this week. So let's go through and let me just add in one more. So let's go through to euro dollar as an example. And let's move it up to the daily, and let's just change that template. Okay, and there we go. So here you can see that lower low, but you can see that this has started to trend higher. Okay, so we've got a lower low there, but here on both these indicators, we've got bullish divergence, started to trend higher. And that is an indication that what you need to take away from that is an indication that the trend is tired, it's running out of steam. It's usually an indication that the higher time frame, the weekly, is overextended and wants to come back to the moving averages. So the lower time frame has started to diverge. And this is what I'm going to be looking for on the weekly charts and on the daily charts, but at least for now. And again, for now, for me, for trading purposes, to recap, because I'm going to wrap up in a moment, it is 1 hour, right? So is it 1 hour or 2 hours, the webinar? It's 1 hour. Sorry, it's 1 hour. I could talk about this forever. I could do this forever. So I love this. It's a hobby and a job. But so we are in a downtrend. And and you can see from these, there are buyers coming into the market. I'm expecting at some point to see the market really tried to turn around this week. It tried. There's definitely some bullish divergence. Look at that. We've got a double bottom here. How much do you want to bet that when I bring on the MACD and the RSI, we're going to see divergence? So we're going to see it going down, and then we're going to see them going up because of this. That is like a double bounce. The markets, if we close up here tomorrow, I think next week we're going to see a push a little bit higher. So it's going to be really interesting because that'll keep, I want to see Bitcoin above that 30,000 level because that'll confirm it's in a trend and tell me what to do for the next year. I'll know what to do for the next year. So let me bring in, where the hell am I, where's my indicators? There we go. Okay, there we go. So look at this. Look at the little double bottom. Look at the MACD starting to bump up. It's very small. There it's much more obvious. Let me show you on the 4 hour. It's hilarious. Okay, so there we go. If we do this, we'll wrap up within a minute, guys. I don't want to annoy you. Double bottom, but clear. This one, not so much. Not so much. Okay, no bullish divergence there. Usually you get it on both. When you get it on both, it's as close to a sure thing as you can get. Anyway, bullish divergence there on those. So it's trying. The market is desperately trying to finish a little bit higher. What's going on this on the daily? Okay, also lower high, a little bit of bullish divergence on that. It's funny because it's the RSI is giving me divergence on the daily, but not on the 4 hourly. So let's have a look at the 4 hourly. Yeah, see, you've got bullish divergence. You've got a lower low here, high low, and a lower low. It's really weird. The RSI is not. I would have expected divergence on both. So what this tells me is if these markets close higher, they are going to try to push higher next week or tomorrow. Or if they close higher this week, they're going to try to hit a little bit higher, which means Bitcoin is going to stay above 30,000. But make no mistake, the market, that bigger move, that bigger picture move is maybe not necessarily over. But I'll note again when we get a strong green candle, nice rejection of those lows. And so what does that mean? Yeah, so for now, I am bearish. I'm looking for short trades to the downside. I am aware that as we go down, eventually we hit those levels. Eventually we're going to bottom out and start to trend a little bit higher. So it is much more about what do I need to see. Once we break these highs, for example, then I start looking for buys because by that time it has started to change. And using these indicators on the 4 hourly and daily, and certainly on the weekly, I can start to see, okay, it's now double bottomed or it's starting to turn around. And again, you know, if all goes well, touch wood, we'll be doing these webinars every couple of weeks. And if I'm presenting, and it doesn't matter what the topic is, if I'm presenting and you come in and you're in the webinar and you say, Adam, could you do a quick analysis on Bitcoin? I will do it. Okay, I'll take 2 minutes and have a quick look at it, and then go, okay, remember we spoke about this, we've seen that, that's what I'm looking for, and we're doing it. Okay, yeah, so Fib and NFX, good. Okay, just wanted to know that. So, okay, good. I'm glad to hear that, Marta, so thank you. And I love the interaction. I really appreciate all the questions. So, ladies and gents, I'm going to wrap it up there for now. Just recapping, and again, this is not financial advice to you. This is just kind of what I would do. If all my cash is committed at the moment, it's really committed. But if I had spare cash lying around, I'd be adding, you know, $500 or whatever of cryptos. I'd be doing it. I'd be just chucking it on if I had the spare cash. I might actually do that in the next couple of weeks. So I'd be doing that. But also in my mind, expectation-wise, is going, look, we're not at the bottom yet because we're not at the bottom. We haven't got that green monthly candle. So we're not, or that strong rejection candle. So I know we're not at the bottom. And so you know that you're gonna have to check each month to get that confirmation. But by looking at the weekly and look at the daily, you'll see it's starting to trend higher. And then you just look at the monthly, oh, it's forming a green candle. Okay, that looks really good. That's the simplest way to kind of do it. In terms of trading, I'd be looking for shorts and very cautious on those as well. Always cautious because all the buy orders sitting at the bottom and bounces. But for now, as to why the markets can go down, why the equities go down, why our crypto's going down, the stuff on YouTube is it just puts spider webs in your brain. It just puts spiders in the brain, snakes on the brain. So essentially it comes down to the big institutions are involved in crypto so they can offer it to their clients. Interest rates are causing them to kind of, you know, people to exit, the word is extricate from their portfolio. That's pretty much it. Once we kind of get a bit of relief on the war, stresses of that and the war and obviously inflation, once that starts to calm down, if everything else is pretty much the same, we should see the market start to recover, and we'll see it recover relatively quickly. Yeah, I mean, if Bitcoin or Ethereum, and I think for me, Ethereum and I have both. I love both. I would definitely diversify. My brother's gone all in on Tesla, and I think I'm just nervous. Like I would put money in Microsoft, I put it in Hershey's, I put it in lots of different things, because actually there are going to be times some businesses do well during a recession and some businesses don't. Some businesses just never stop. Costco always makes money. So I like Bitcoin and Ethereum because I don't know in 5 years time which one's going to be where. I don't know that for certain. I'm going to be watching it, we'll see. So same thing again. That was it. Sorry guys, let's just go back to the slide deck. So for me, not that one. There we go. So that's it. That's the last slide. Look, I love this, and I hope you enjoyed it, and I hope you found it instructive and useful as well. I hope you did. And I really look forward to seeing you in future webinars. I don't know if you liked having the video on, if it matters or not, but it's sometimes nice to see a person's face, and I can feel like I'm talking to you now rather than just a voice. Thank you. Yeah, and okay, good, great. Thank you. I'm appreciating the feedback. And that's it. I look forward to seeing you. And well, in future markets, like I said, anytime I'm presenting, bring any questions you have, bring them in. If I've got a moment, I will always cover them in that. And yeah, and let's see what happens with all this. Okay, good. I appreciate that. Thank you. There's lots of nice compliments coming through, so thank you. All right, I'm going to end the webinar now. It's going to kick us all out, and I want you to please enjoy the rest of your evening. And I look forward to seeing you in future webinars. So take care. Don't risk too much. Be cautious, and we'll see you soon. Thanks.